To effectively advise on individual market movements, a wealth manager must first map the broader macroeconomic environment those markets operate within. The foundational metric used to quantify this total economic activity is national income. We can construct this system from first principles, starting with a closed two-agent loop and expanding it outward into a globally integrated open economy. Doing so allows us to define exactly what gross domestic product and gross national product actually measure. Mastering these mechanics provides the framework necessary to translate theoretical shifts in the economy into informed investment decisions. The bedrock axiom of the economy is a continuous, dual-directional loop between two primary agents, households and firms. The physical foundation is the production cycle. Here, households supply the factors of production: land, labor, capital, and enterprise. Firms combine these factors to manufacture and supply goods and services back to those households. Running in direct opposition to this physical exchange is the income and expenditure cycle. Firms pay households wages, rent, and dividends for their labor and capital. Households then expend that income, sending capital back to firms to purchase their produced goods. In this simplified, closed model, total income perfectly equals total expenditure, which perfectly equals the value of total output. Grasping this theoretical equilibrium provides the baseline against which all real-world market volatility is measured. This formal diagram illustrates how a modern open economy expands the basic loop by introducing external flows. The top half of this model shows what economists call leakages. These are channels where capital is actively removed from the immediate circular flow. The first major leakage occurs when individuals save a portion of their income for future consumption, rather than spending it immediately. Second, government taxation strips revenue directly from both firms and individuals. Finally, capital exits the domestic system entirely when households and firms purchase imported foreign goods. Tracking these leakages is critical for wealth managers. Every dollar that leaks out represents capital that is unavailable for domestic corporate revenue generation. Counteracting those leakages are injections, external capital pushed back into the domestic economic system. Financial markets channel saved capital back into firms to fund new business investment and capital equipment. Governments re-inject tax revenue by spending on public sector jobs and infrastructure. And foreign economies inject capital when they purchase domestically produced exports. This brings us to the formal expenditure equation shown here. Gross domestic product is calculated by adding consumption, investment, government spending, and net exports. To find net exports, we subtract the leakage of imports from the injection of exports. This formula provides an indication of the level of economic activity taking place within a country during a calendar year. While GDP measures the total market value of final output produced within a country's geographical borders, it fails to capture who ultimately retains that wealth. For that, we use gross national product, which factors in net property income. GNP measures the economic contribution of a nation's citizens and firms, regardless of where in the world they operate. Consider a Japanese multinational firm producing cars within the UK. The physical output of those cars is counted strictly toward the UK's GDP. But if that firm repatriates £50 million in profit back to its shareholders in Japan, that outflow is subtracted from UK GNP and added to Japan's GNP. A nation can exhibit high domestic production, padding its GDP, while simultaneously bleeding wealth to overseas investors. GNP provides the secondary metric required to assess true sovereign financial health. When reading national income accounts, analysts must account for a critical vulnerability in the raw data. Because GDP is collected at current market prices, the raw figure you see is nominal GDP. If a country produces the exact same amount of goods this year as last year, but prices double, nominal GDP will double. This creates the illusion of economic growth, despite stagnant physical output. Looking at this chart, we see how the GDP deflator corrects this. It is a statistical tool that strips out broad-based inflation from the nominal GDP bar, revealing the true real GDP underneath. Unlike the Consumer Price Index or Retail Price Index, which tracks specific baskets of household goods, the GDP deflator captures price changes across the entire domestic economy. Failing to distinguish between real and nominal metrics guarantees an analyst will mistake dangerous inflationary pressures for healthy economic expansion. Even when adjusted for inflation, GDP has inherent limitations for investment strategy. It is a lagging indicator. The data takes significant time to compile and is subject to constant, time-lagged revisions by government agencies long after the market has moved. It also contains massive blind spots. GDP ignores the unrecorded shadow economy, non-marketable production like home repairs, and the value of leisure time. Furthermore, it counts high production as an absolute positive, completely failing to account for negative externalities like severe environmental pollution or infrastructure congestion. The macroeconomy is a perpetual engine. Every variable, from consumer spending to foreign net property income, continuously loops back into the system. Advisors use this circular flow framework to contextualize economic indicators, providing a structured way to evaluate the implications of shifting fiscal and monetary policies.